Hi, my name's Jalal and I work for Make Happen. We're the Essex Region's OFS UniConnect partnership. Today I'm going to be talking to you about a really important topic called financial capability, and in particular about developing your financial capability. The aims of today's session are to develop your financial capability by introducing a range of important financial terms and concepts, and to encourage you to implement good financial practices into your own life. So, what is financial capability? A financially capable person is someone who keeps track of their money, plans ahead, and is able to make informed decisions about their finances, understanding the risks and benefits of particular options. Really importantly, a person's financial capability is best judged by their actual behaviour and not just their skills and understanding. So in other words, it's what they actually do and not just what they say or what they think. So let's start off then with a quick fire quiz just to get you guys warmed up to some of the topics we're going to be talking about today. So the first question: which term describes your bank account if the balance drops below zero? Do you think it's underbalance, overbalance, bank draft, or overdraft? Well, the answer to this actually is overdraft, and I'll come back and talk about what that means in a little while. Second question: what is the national minimum hourly wage for workers under the age of 18? Do you think it's £2.50, £4.35, £6.20, or £8.65? So the answer to this one is £4.35. So that's how much you would be legally entitled to earn as a minimum if you had a job now. Next question: how old do you have to be to apply for a credit card? Is it 11, 16, 18, or D, you can only get a credit card when you have a certain amount of money in the bank? The answer to this is C. You have to be 18 years old to apply for a credit card. Question 4. What is the name of the extra money that is added when you do not pay off a credit card balance in time? Do you think it's credit, interest, national insurance, or VAT? And the answer is interest. And again, we're going to be coming back later on in the session to talk about what that means. So let's move on now and talk about some of the key concepts involved in financial capability. So we're going to start off by looking at money and the world of work. So in the UK, there is a minimum pay per hour that most workers are entitled to by law. This is known as the national minimum wage. For workers at age 25 and over, they're entitled to something called the national living wage, and that's the highest rate of the national minimum wage. Do you know how much you'd be earning as a minimum if you had a job now? Well, you should remember from the quiz. So as you can see in this table, depending on your age and whether you're an apprentice or not, this is how much you would be entitled to earn as a minimum. So it starts at £3.90 per hour for an apprentice, it goes up to £4.35 for under 18s, £6.15 if you're between 18 and 20, £7.70 for 21 to 24-year-olds, and finally £8.21, which is the national living wage for those who are 25 and over. There are also a number of ways people are paid for the work that they do, and we're going to go through 4 of the main ones now. So the first is called a salary. So a salary is an amount you are paid per year for doing the work that you do, and usually you're paid once per month, which is a breakdown of your salary divided across all months, and you're usually paid the same amount each month. You can also be paid an hourly rate. So this is when you get paid for each hour of work that you do. And if you do more hours, you'll obviously earn more money. So that refers to some of the numbers we saw in the previous slide. Those were hourly rates. You can also be paid via something called piecework. So this is when you're paid for each output, for each work that you actually do. So for instance, you can think about a Deliveroo driver. They're paid for every delivery of food they make, not necessarily for how long they're actually working for. And finally, commission. So that you usually find this in sales-based jobs. So you'll get paid a certain percentage of the amount of sales you make. And that's usually tied to a salary as well. So you'll have your base salary and you can earn extra if you're able to make additional sales. So those are 4 of the key ways that you can actually be paid for the work that you do. There are also a number of different ways that you can be employed in the UK. The most common ones include full-time. So this is when you're employed for equivalent of up to 36 hours a week. So when you hear people talk about a 9 to 5 or Monday to Friday job, that's what they mean, a full-time job. There's also part-time. So part-time is anything less than those 36 hours a week. So it may be that you're working less than 5 days a week, or you might be working less hours per day than someone on a full-time contract. There's also what are called fixed terms contracts. So these can be either full-time or part-time, but it's when your job only exists for a certain set period of time. So you might be employed for a month, for 6 months, for a year, but after that your job will kind of expire. And finally, 0 hours contract. So these are when you're not guaranteed any number of hours in your particular job. So they might vary and fluctuate depending on your employer. So let's move on now and talk about some banking basics. So let's start by looking at bank accounts. You can open a bank account with a bank, a building society, or a credit union. And these offer 2 main types of account. The first one is called a current account. So this is an everyday account which allows money to be paid in or taken out. It's what you use to cover your day-to-day expenses. So whether that's when you set up direct debits to pay bills, you can get your salary or your pay paid into a current account, and it helps you to budget and manage your money. They're generally free to use, but you need to be 16 years old or over to open a current account. The other main type of bank account is called a savings account. So these are specifically designed to save money in, and they're usually best for saving larger amounts. So unlike a current account, you can't necessarily pay bills from a savings account, you can't have your wages paid into it, and some savings accounts, once you put that money in, you actually lock it away and you're unable to access it for a certain amount of time. But the point of savings accounts is that the amount you put in can grow due to the interest that is added just for having your money in that savings account. And with savings accounts, there are specific accounts designed for children up to the age of 18, and then there are a range of savings accounts available to adults. There are also a number of different types of card that you can use with your personal finances. So you may be familiar with some of these, and probably some more than others, but let's go through 4 of the key card types now. So we've got debit cards, credit cards, gift cards, and store cards. For each of these, I want you to think about how is it used, where can you use it, and who can use it. So let's go through each of these now. Let's start with debit cards. I want you to think about how is a debit card used. So a debit card is used to withdraw money from your account or to pay for goods or services. The important thing to remember with debit cards is that it's only the money you have in your bank account that is available to use on that card. In terms of where you can use it, A debit card can be used at a cash withdrawal machine or ATM, in shops, or for online shopping. And finally, who can use a debit card? These can be used if you're at least 11 years old. So I'm sure some of you listening probably have your own debit card that you use. What about credit cards? How is a credit card used? Where is it used? And who can use it? So let's start by looking at how a credit card is used. So it's used to pay for goods or services even if there's not enough money in your account. So unlike a debit card where you can only spend the money you have in your account, with a credit card you can spend more than the money you have because you're effectively borrowing that money from the credit card company or from the bank. Where can you use credit cards? Well, similarly to a debit card, it can be used at an ATM, in shops, or for online shopping. And finally, who can use credit cards? Credit card can only be used for people that are at least 18 years old, and they also must pass something called credit scoring. So credit scoring is when a bank or a credit card company will basically look back at your financial history just to see whether you've shown that you've been quite responsible with your money, whether you've been in any trouble with money in the past, and depending on that they may decide to give you a credit card or they may not. The important thing to remember about credit cards is that if you don't repay the amount that you accrue on a credit card, the amount that you build up, that you borrow from the credit card company, if you don't repay that in full, interest can get added to it, which means you'll end up having to pay back more than the original amount. So each month you usually have to clear the balance you've built up on your credit card. Next one, gift cards. So I think this is probably the one you're most familiar with. So what's a gift card used for? Where is it used? And who can use it? So a gift card is a card preloaded with a set of monetary value, and it's basically used instead of cash. So for example, it could be loaded with £5, £10, and you usually see these given at birthdays and Christmas. Where can a gift card be used? A gift card can be used in shops or online, but with specified retailers only. So in this case, you have an iTunes gift card that could only be used to pay for purchases in iTunes. You wouldn't be able to go and buy your shopping in Tesco's with it. And in terms of who can use a gift card, it's for use by anyone, just the same as cash. Finally, let's look at store cards. So these are a little bit different and a bit tricky, but can you think about how a store card is used, where it can be used, and who can use a store card? So, a store card is used just like a credit card to pay for goods or services in a specific shop. So a store card is not a reward card or a club card, which is what I think a lot of people get confused with. It's basically a credit card, but it's only for use in one specific retailer. So obviously in terms of where it can be used, in-store, online, but only for a specific shop. So you can spend in that shop and buy things even if you don't have money because you're borrowing using that card. And again, exactly the same as credit cards, it's for use. It can be used by people aged 18 or above who pass credit scoring. But again, you'll have to pay interest on any outstanding balance if it's not repaid in time. Okay, good. So let's move on now to another really important concept in terms of developing your financial capability, and that's saving. So saving is putting away money for future use. This may be in a bank account, or it could be under your bed. Saving could also refer to reducing your spending. Savings, on the other hand, are the value of the money that is being put aside. So for example, if you have £50 in your bank account, that is your savings. If you then arrange to put a further £10 in each month, that is the amount you are saving. There are a number of different reasons why someone might want to save money. Can you think of some now? So, 3 of the key reasons why people save are for a specific purpose or to help achieve a particular goal. So maybe there's something you want to buy or there's something you want to achieve and you'll save up for it. To put money aside for unplanned events. So if something unexpected happens and you've got savings, you'll be able to cover that unexpected cost. And finally, to keep your money safe. So although I said you could save money under your bed at home, it probably wouldn't be a good idea and the safest place to have cash lying around in your house. So keeping it in a bank account, in a savings account, for example, is a good way to keep your money safe. Now, obviously, there are pros and cons to everything you do with money, and saving is no different. So in terms of the benefits and the disadvantages of savings, let's look at those now. So the pros of saving, saving means you can, for something means you don't need to get into debt in order to buy it, you'll be buying it with your own money. Having some money saved can be useful for when unexpected events happen. So as I just mentioned, for unforeseen costs, if you have savings, you'll be able to cover those. And finally, buying something up front is usually cheaper than borrowing because of something called interest, which we'll talk about in a second, but it's basically the extra money you have to pay back on top of the amount that you borrow. So those are some of the pros of saving money. What about some of the negatives? Well, there's one really clear and obvious one. Saving means you have to wait to buy something, because obviously it takes time to save up. And for big, expensive things, this can actually be a very long time. How to save? So sometimes getting the money to save in the first place can be a challenge. And there are 4 main ways in which you can get money to save. Firstly, you can earn it. So whether that's taking on a job or some part-time work, and you can earn money to save. You can be given it. So whether that's from a birthday present or any sort of gift that you receive from your friends or family. You can reduce your spending. So by reducing the amount you're spending, you'll have extra money to save set aside. And finally, you can sell things that you own. So whether that's through online websites or amongst your friends, you can sell some of your old possessions and generate some money that way to save. Now I want to go through a real life example of how I managed to save using one of these methods. So sometimes you can save a lot by just cutting down on a small but regular expense. So in my case, every day before work, I used to buy a coffee from Costa for £2.20. And although this may seem like a small amount, and I didn't think much of it, it wasn't breaking the bank. When I was purchasing this every day, the total cost can quickly add up. So I calculated that actually, although it seems like a small amount on a day-to-day basis, that meant I was spending £11 a week on coffee. And then I worked out that would be £44 a month on coffee, which is starting to look more and more significant and like a larger amount of money. And finally, I calculated that I would be spending £572 a year on coffees if I was to carry on buying coffees every day before work. So I decided to cut that out and stop purchasing them. So just by doing a small change like that, I was able to save a huge amount of money. Can you think of a small, regular expense that you could cut down on and save instead? Maybe thinking about working out how much you would save in a week, in a month, or even across a whole year. You might be surprised. So that was saving. Now let's move on and talk about another really important concept, which is borrowing. So borrowing is when you receive money from an individual or organisation and promise to pay it back at a later date. In most cases, there is a cost to borrowing due to interest. So interest is the extra money you pay back on top of the money you originally borrowed. And you can usually see the interest rate of a particular form of borrowing expressed as something called APR. And I'm going to talk about what that means, but in short, the higher the APR, the more expensive that form of borrowing is. So interest, let's look at what that means. So different forms of debt have different interest rates. You can work out the cost of a loan or compare different loans by looking at the APR. For example, let's say you wanted to take out a loan of £10,000 over 1 year and you see these two offers advertised. So the loan company are offering you a loan with 10% APR. Reliable Lending, on the other hand, are only charging you a 5% APR. So in the case of the loan company, the total amount you'd have to pay back if you were to take out that £10,000 loan with a 10% APR would be £10,550. However, if you were to use Reliable Lending, the total amount would be less. It would be £10,272. So because of the lower APR, it's a cheaper form of borrowing in this case. However, to work out the total cost of a loan, you also need to factor in the length of borrowing, so how long you're going to be borrowing that money for, and not just the APR. So let's again put this into an example to help explain what I mean. Let's say again you were thinking about using the loan company to take out a £10,000 loan at 10% APR over a 5-year period, or Reliable Lending taking out the same loan with 5% APR but over a 20-year period. Which one would be more expensive in the long run? Well, let's look at the numbers. So with the loan company, the total interest you will pay back, so the money on top of the original £10,000, would be £2,750. For Reliable Lending, however, although the APR is lower, because of the fact that you're borrowing over a much longer period of time, the total interest will be £5,840. So it will be a lot higher than the loan company. So this is an example to show how you have to look at the length of borrowing and not just APR to work out the total cost of a loan. So let's look at the pros and cons of borrowing now. So the pros of borrowing are that it allows you to buy something now rather than having to save up for it. Helps you to buy things that you would struggle to ever pay for upfront. So for example, a house. So when we looked at saving, we said that it can sometimes take a really long time to save up for some expensive things. In some cases, you might not ever be able to save up for it. So for example, a house, you would need to take out a mortgage, which is a form of borrowing, to buy a house. And finally, borrowing can help you to cover unexpected costs if you don't have those savings set aside to help in those cases. What about the cons of borrowing? So, added interest means that borrowing costs more than paying for things up front. So again, that's due to the interest that's added. Secondly, if it's not managed carefully, debt can sometimes spiral out of control. And as we've seen, just through time passing, the amount you owe can escalate quite quickly. Finally, missed payments can have a negative impact on your credit score. So as we discussed earlier, credit score is a kind of history of your financial performance. So if you've missed some debt repayments, that will go on your credit record, and when you're looking to borrow money in the future, it might count against you. So let's quickly look at different types of borrowing, and these are ordered from the lower interest, so the lower APRs at the top, down to the higher interest. So let's start with mortgage. So a mortgage is a form of loan you take out with a bank or a building society to usually buy a property, to buy a house. And the interest rates on mortgages are quite low, but that's because they're taken out over a very long period of time. So it might be over 20 years, 25, 30 years. So it's a really, really long commitment. Student loan. So this is a loan that people get from the government to help pay for their tuition fees and their living costs when they go to university. And then you then pay it off when you earn over a certain amount after you finish university. Personal loan. So this is a loan you can get out from a bank, for example. It might be to buy a car, to make some renovations on your house. Overdraft. So an overdraft is a facility in your bank account that allows you to take, when your balance drops below zero, you can effectively borrow money from your bank up to an agreed limit, but there's usually a charge for the facility for you to do that. Credit card, we've touched upon already. It's a form of card which allows you to purchase things even if you don't have money in your account, and then you then pay that back by the end of the month. Otherwise, interest is added on your balance. And finally, payday loans. So these are really expensive forms of short-term credit, which are designed if you don't have enough money to quite make it to the end of the month before you get paid, just to kind of cover you. But as I say, they're really, really expensive. And I know what some of you might be thinking. Isn't it always bad to be in debt? Well, what I want to sort of get across today is not all debt is the same. It is important to only borrow when it is affordable and appropriate to do so. At some point in your life, you're going to need to borrow money for something. So it's important to learn when it's right to borrow. In most people's cases, they'll need to take out a mortgage to buy a house, and that is a form of borrowing that they'll need in order to make such a big purchase. So good debt will provide an ongoing benefit to the borrower or will result in some kind of financial return. Bad debt, on the other hand, does not provide an ongoing benefit or a financial return to the borrower. So what I want to do now is look at a few scenarios, and I want you to decide whether you think they are examples of good debt or bad debt. So, the first one. You want to go on holiday because you haven't been away for 3 months, but you need to pay for it on a credit card. Do you think that's good debt or bad debt? Well, I think that is an example of bad debt. Just because you haven't been on holiday for 3 months, it wouldn't be the end of the world, and you'd probably be better off saving for it and going when you can actually afford to. Next scenario. You recently got married and now it's time to get your own house. You need to borrow money by getting a mortgage in order to do so. Do you think that's good debt or bad debt? I think this is an example of good debt. As we saw a second ago, good debt is a form of investment for your future, and it provides an ongoing return. So in this case, you'd be living in your own house, and that will actually be a financial asset for you. So if you decide to sell the house in the future, you may actually make a financial gain. Next scenario. You've just got a job, moved house, and live 8 miles from work, and your children go to a school that's 10 miles away. There's no public transport, so you borrow money for a car. Do you think that's good debt or bad debt? I would say this is good debt. So although a car doesn't provide the same sort of financial return as, say, a house, it's definitely helping this person in terms of their quality of life, and it's also a necessity. So they need to get to work, they need to drive their kids to school and pick them up. So it's something that would definitely contribute to their overall life quality. So I think it's good debt. And finally, you have a store card with a limit of £500 and you're off to a big party tonight. You see some nice party clothes that cost £250, so you go for it. Do we think that's good debt or bad debt? Now hopefully I think everyone would agree that's bad debt. You shouldn't necessarily be using a store card to purchase some clothes for a party if you can't afford to buy it up front. So let's move on now and talk about our final section, which is about budgeting. So what is a budget? A budget is a record of your money coming in, which is known as your income, and the money going out, known as your expenditure. By keeping track of your money through a budget, this can help you to maintain good financial health by ensuring you have enough money to cover all of your outgoings. You can also identify expenditure that you can cut down on, especially small but regular spending, so just like me with my coffees before work. You can also calculate your spare money that you have left aside after you've covered all your expenses, and you can either then spend that money or save that. And all of these are really important for developing your financial capability. So we've looked at what budgeting is and the benefits of it. How do you actually go about budgeting? So the first thing you need to do is start by working out the total money you have for each week. You then take away the amount you need to spend on essential items per week. So that's something like transport. And finally, whatever money you have left is your surplus money to save or spend on non-essential items. So let's put this into an example. Let's say this person earns £200 a month through a part-time job, and they also get a £30 allowance from their grandparents every month. So their total income would be £230 each month. Their essential expenditure, so the expenditure they need to survive, comes to £150. So that includes transport, money they put into savings, a gym membership, and a phone bill. So in this case, this person would work out that they have a monthly disposable income of £80. They can use that to spend, or they could top up their savings so that they would be saving more. But that £80 is for them to choose what they want to do with. So let's recap. In this session, we've developed your financial capability by introducing a range of important financial terms and concepts. We've applied these to some practical scenarios and hopefully encouraged you to implement good financial practices into your own life. Let's do a final quiz then to see if you've been understanding and listening to this session. First question, what is a mortgage? So hopefully you remembered that a mortgage is an agreement that allows you to borrow money from a bank or other financial organisation, especially in order to buy a house. Next question, which usually has a higher interest rate, a student loan or a payday loan? The answer to this one is a payday loan. So typically, a student loan has an interest rate, an APR, of between 2.4 and 5.4%. A payday loan, however, has an average APR of 292%. So it's a lot higher, and as I said, it's a very expensive form of borrowing. Next question. What is a store card and how is it used? So this is what we talked about right at the beginning, and hopefully you remembered that a store card is basically used like a credit card to purchase things on credit and pay them off at the end of the month, but it can only be used with a specific retailer. How old do you need to be to open a current account? Can you remember this one? 16 years old. So that's the end of the session. If you've got any questions, please log on to our website and you'll be able to get in touch. I hope you enjoyed the session and you learned something new.